Some of the safest, most trusted companies in the world are actually terrible investments at the wrong price? Stay with me until the end because most people never learn this about money, and understanding it could completely change how you invest forever. And before we go deeper, quick question. When you think of investing, do you usually go for big names like Apple or Microsoft? Or are you still trying to figure things out? Let me know in the comments. I read every single one. A few years ago, a beginner investor bought shares of a very famous company. He felt confident. The brand was strong. Everyone knew it. Even top investors had owned it. So he thought, this is safe. But over the next few years, something strange happened. The company kept growing. The business stayed strong. The news was positive. But his returns? Almost nothing. In some periods, even negative. And that's when he realized something that most people learn too late. Right-finger a great company does not always mean a great investment. And the reason comes down to something most beginners ignore: how to actually evaluate a blue-chip stock properly. Now here's the problem. Most people buy stocks based on popularity headlines or what someone else is buying, but smart investors, they follow a system. Today, I'm going to show you a simple 5-step framework that can completely change how you pick stocks. First, revenue growth. This is where everything starts. Because if a company isn't growing, it's slowly falling behind. You don't want a business that's just surviving. You want one that's expanding. Look for companies growing at least 5 to 8% per year. Because that tells you one simple thing: people want what they sell. Demand drives long-term value. Second, return on invested capital. Now this might sound complicated, but it's actually simple. It answers one question: how well does this company use its money? If a company invests $1, how much profit does it generate? Great companies are efficient. They don't just grow, they grow smart. This is why some of the biggest companies in the world dominate for decades. Because they know how to turn capital into results. Third, free cash flow. Now this is where things get real. Because profit can be adjusted. But cash? Cash doesn't lie. Free cash flow is the money left after everything is paid. And this is what companies use to pay dividends, buy back shares, invest in growth. If cash flow is rising consistently, that's a strong signal of a healthy business. And here's something most people don't realize: companies don't fail because of low profits. They fail because they run out of cash. Fourth, debt levels. Imagine this: the economy slows down. Sales drop. Uncertainty rises. What happens next? Weak companies struggle to survive. Strong companies stay calm. That's why you need to check how much debt a company has, and more importantly, can it handle that debt during tough times? Because investing is not just about growth, it's about survival. Now here comes the most important step: valuation. This is where most people make their biggest mistake. Because they find a great company, and then they overpay for it. Let me explain. You could buy an amazing business, but if you pay too much, your returns shrink. Sometimes dramatically. This is why some investors buy popular companies, and still see disappointing results. Because price matters. Always. A great company at a fair price is far better than an amazing company at an extreme price. Now here's where things get even more interesting, because great investing is not just about numbers, it's about context. You need to connect companies to the world around them. If technology keeps growing, certain companies benefit. If global payments increase, other businesses grow. If the economy slows down, different companies become more stable. This is how experienced investors think. They don't just buy stocks, they understand where the world is going. Stay with me until the end, because the next idea might completely change how you think about your portfolio. Before you invest in any company, ask yourself 3 simple questions. Will this company still matter in 10 years? Does it have something that competitors can't easily copy? And would I feel comfortable holding it during a major market drop? If the answer is yes, you're looking at something strong. If not, it might not belong in your portfolio. Now let's quickly go over the biggest mistakes people make, because avoiding mistakes is just as important as making good decisions. Buying stocks just because they're famous. Following what other investors are doing without understanding why. Ignoring valuation completely. And putting too much money into one single sector. These mistakes don't feel dangerous in the moment, but over time, they can quietly destroy returns. So what's the smarter approach? Keep it simple. Choose a few different sectors, and pick strong companies within each one. Or, if you want an easier path, own a broad market fund like the S&P 500. That way, you're not depending on just one company. You're building exposure to an entire system. And here's the final truth. The real goal of investing is not to chase the next big thing. It's to build something that lasts. Something you understand. Something you can hold, even when the market gets uncomfortable. Because it will. And when that moment comes, the investors who win are the ones who know exactly why they own what they own. If this video helped you understand investing in a simpler way, make sure to like and subscribe, because on this channel, we break down money, investing, and wealth building in a way that actually makes sense. And if you want to go deeper, check out the next video on your screen. Stay in touch for more information.